Hi everybody, this is Gary Dean, and this is our nightly video report for Tuesday, March 1st, 2016. Didn't really see this one coming today. I mentioned that the S&P stopped right at the bottom of this wedge right here. It was right at a moving average, and the bears needed to push it through to get momentum going, and we'd probably see a quick move down to the 1900. So left the door open for a bounce. Didn't really see a 46-point short squeeze in the works. Not really quite sure what was the trigger for it, but that doesn't really matter to us. So I took another third, and really one of my main reasons was we have the S&P that was in the top of the where we saw selling going on. And you can see total money flow was minus 125, block trades minus 44. So we know that there was selling going on. That doesn't always mean that the market has to reverse right away. Second is we're in this bearish rising wedge still. We have bearish divergences, very overbought. But that's not the reason why I actually took the trade. Was if we look on a 5-minute chart, I was really going off of this. It's another bearish wedge that's in place. Actually, every chart has it. So I took it when it was right here, pulled back, and then the last minute of trading, we saw the S&P rally some, 6 points or something in the last minute. Usually that's just shenanigans going on. It doesn't really mean a whole lot. But even on the 5-minute chart, you can see we have bearish divergences. 15-minute chart, from here we kind of grinded up. We saw bearish divergences, very overbought. And really, right now, I mean, did things change? Maybe. And what I mean by that is it would have made more sense if we came down, at least for where I was saying that, this was your wave B here, and we were starting to wave C down. The fact that we, went up 46 points and took out these previous highs now has to leave the door open that we possibly could go all the way up to the 1999, possibly all the way up to the 2023 or the 2051. We don't, I don't know that yet. What you do is you try to put the odds on your favor, and we had bearish divergences. We hit the 50% retracement. We went down. Today it caught a lot of shorts by surprise, and I think it probably added an extra 25 points to the rally today when shorts were covering. But usually when we see these types of moves, they usually retreat, and usually 30 points is about the number that they pull back on. So whether the last push up was the wave B and we reverse down, or we're going to pull back some and then head up, I got to be open-minded on it. Today, like I said, took me a little bit by surprise. But if we take a look at the 60-minute chart here, we're still within this wedge right here. So this would be saying that it still has another 10 points higher before hitting the top of the wedge, but the pattern's bearish. It's not a bullish pattern, meaning that it's not a sustainable. Usually, it's not a sustainable rally. So we have that resistance there, and if we look on a 15-minute chart, you can see we have bearish divergences, and we're at the top of this wedge here. And like I was saying, a 30-point drop would bring us right around the 23% retracement level. So it's that's actually 40 points. But this is what I mean by when you get these big moves. This is 30 points. This was how much was this? This was 61 down to 30 points. So when you get these big moves like this, I think this one was a little bit less. 30, no, it's 30 points. So that's really what I'm looking at right now is a pullback, 30 points in that range. From there, let's. I think probably the best thing that we would want to do is probably move to cash and see how things work out from there, because obviously the original plan that or the pattern I think is better to say that I was watching was the wave B ended, and we were going to start the wave C down. But obviously things have changed, so we just want to, kind of adapt to it instead of, kind of holding our breath and saying that the markets are wrong, because the markets are always right. And, we want to just kind of move along with the markets. So if we get the pullback, say down to the 1940 in this range here, then maybe we want to just take things off the table. We'll probably walk away with the break-even trade, maybe up a couple dollars, nothing major. And if it continues higher, really my thing is going to be right around that 1988 level, because if we start breaking above it, then we're going to 1999. But usually, that's what they do as far as they look for the most pain. And if they go up 20 points, a lot of shorts will be in pain. I won't be happy because it was, we got in. We were up on it. We were up on it a couple times, and then we got, this took place. So anyway, really my biggest thing is the overall pattern where this wave B ends. It doesn't change the fact that once it does end, we're going to get this wave C down. It's just a matter of where it turns. And this is why I'm saying we want to be a little cautious on things. And, if we get a pullback and it does its normal 30-point drop on it, then we turn around and we step out and regroup. And if it continues lower, then we just wait for a bounce and then we short it then. But I'm more on with my last entry today. It wasn't because I'm overly bearish right now. I don't think the markets are safe to buy by any means, just because of where we are and stuff like that. But it's we should have went lower today for the pattern that I was following to play out, but it's still trading within a bearish rising wedge, so that's not really a safe thing to be jumping on the long side. So let's see what plays out tomorrow, and have a great night.